calls made by any of the people following this approach. And I want you to understand it because you can use it over and over and over. If you could know once a bear market started where it was likely to end, you would know more than most of the people watching the chart. Most of the people don't even know a bear market's in force, much less where it's going to end. Let's find out. Elliott stated it this way after observing hundreds of examples. He said, a correction usually finds its lowest point in the area of the fourth wave of the preceding impulse wave of the same degree. Got that? Well, so anyway, close those doors, we're going to have a quiz. A correction usually finds its lowest point in the area of the fourth wave of the preceding impulse wave of the same degree. Now, it's one thing to hear that verbally, but it'll be very clear if we can see it on a chart. And this chart does contain a clear example of what Elliott was talking about. Let's look at wave 2 here again, this 5-year bear market from 1937 to 1942. Once it was clearly in force, it might have been valuable to know where it would bottom. And Elliott said, well, take a look at the previous impulse wave of the same degree, which is wave 1, and observe the span that the fourth wave within that movement covered. And of course, that's right here, from the 3 top to the 4 bottom. So if you look at this low, which occurred in 1942, move your eye back to the left, you will find that it occurred right in the area of the preceding fourth wave. Right in the area of the fourth wave of the preceding impulse of the same degree. Now, that's not the only example on this chart. There's another. Let's take a look at this sideways movement, all of which is a correction from 1966 to 1982, and look at its lowest point. That was right here at the 1974 bottom made in December. Again, if you move your eye back to the left, you will find that it occurred right in the area of the previous fourth wave. That's exactly why Charles Collins said in 1966, a month off the high, this market is likely to carry into the 500s, because that is the area of the fourth wave correction which occurred in 1962. This guideline holds true, like all the others, at all degrees of trend. You'll be watching a long-term chart like this and have an idea of where a bear market lasting years might bottom. You might be looking at a real-time chart on your quote machine with 5-minute bars. You can make the same observation with that. It occurs over and over and over. It is a guideline, however, not a rule, which means that sometimes that area is not achieved or even exceeded by a slight amount. As long as the rules aren't broken, a wave structure can be valid. But this guideline is extremely helpful in identifying what the probabilities are for the end of the correction. As long as we're on this guideline, let's apply it to this chart on the larger trend. If indeed we have completed from 1932, 5 waves up, Roman numerals 1, 2, 3, 4, and 5, or have nearly completed wave 5, then where is the next bear market likely to find its price low? Well, the answer would be in the area of the fourth wave of the preceding impulse of the same degree. Well, you might first make a decision that this fourth wave is the area that you would find support. And of course, the low was at 572, and the high was about 1052 on the Dow Industrial Average. Now, I would contend that that's enough risk to be out of the market until that area is achieved, or until a price pattern of bear market style, of corrective style, has been completed. However, those of you who are very observant have probably noticed that we have snuck a larger 3 marked with a Roman numeral in parentheses here at the 1929 high, and put a 4 down here at the 1932 low, which would indicate that the entire advance from there is a fifth wave of something much larger. A.J. Frost and I made the case in our book, Elliott Wave Principle, back in 1978, that that was indeed what was going on. That even though we hadn't seen the 80s bull market yet, when we saw it, it would not only end a five-wave structure upward from 1932, but likely one that had been going on for 200 years. Let's take a look at the bigger picture. Here. Now, one of the most amazing conclusions that R.N. Elliott made with limited data was exactly that. That the late 1920s had finished a third wave and that the ensuing drop was a fourth. He only had stock data going back to the 1850s, late 1850s. And of course he was making his decisions on this basis in the early 1940s. He died in 1948. So all of the data that we had going into the 1970s when we wrote our book was not available to him, and yet he came to the same conclusion. Well, the reason Frost and I were able to substantiate that idea was that the Foundation for the Study of Cycles in the 1970s created a chart of U.S. stock prices back to the founding of the Republic. They took the Dow Jones Industrial Average back as far as it would go, spliced it to the Axe-Houghton Index and the Cowles Commission Index. Prior to that, from what I understand, they went back to New England Town Records to recreate what stock price values were all the way back to 1789. Now, it must be assumed that a good deal of this data is tentative at best. Regardless, it is remarkable how well this data reflects the five-wave structure that Elliott said is classic to all markets. Let's take a brief look at this development. Here we are in 1789, and the market is moving up in what is apparently a wave 1. Did the late 1700s have that quality of a question of survival for this particular market? I'd say they certainly did. Had the colonies not won the Revolutionary War, we wouldn't be looking at a chart with the label U.S. stock prices today. So there was certainly a question of survival there. And I believe it's correct to say that Wave 1 occurred during a period when there was a good deal of doubt and uncertainty about whether the new country would make it. Wave 2 then occurred, brought us into a low in 1842, had a rebound, and then another low in the late 1850s. Now remember I said that Wave 2 usually recreates the same style of fear that people had at the actual bottom. I'd like to read to you a quote from Harper's Magazine from 1847, which I believe reflects the kind of sentiment that was prevailing during this big second wave. It is a gloomy moment in the history of our country. Not in the lifetime of most men has there been so much grave and deep apprehension. Never has the future seemed so incalculable as at this time. The domestic economic situation is in chaos. Our dollar is weak throughout the world. Prices are so high as to be utterly impossible. The political cauldron seethes and bubbles with uncertainty. Russia hangs, as usual, like a cloud, dark and silent upon the horizon. It is a solemn moment. Of our trouble, no man can see the end. Well, people thought the Great Depression was bad. That was Wave 4. This is the way people felt during Wave 2. Now, what occurred right at the end of the second wave? It was actually a little bit late relative to usual development of fundamental events. That second wave ended in 1859, and what happened immediately thereafter? Civil War. Now, again, Does this suggest the same kind or style of fears that occurred at the actual bottom? The Civil War was a war fought on our own soil, just like the Revolutionary War. It was a test of the Union, which was very similar to the battle or the war which created the Union in the first place. So wave 2 had the same style of fears, or generated the same style, as the actual low did. That was the base from which wave 3 was launched. Wave 3 occurred from the late 1850s all the way to 1929. And what a wave that was. The United States was the only major country in the world that sported essentially a laissez-faire economy. Taxes were virtually zero, and the production reflected that. From the Civil War right into the 1929 high, the percentage rate of gain in growth in this country was phenomenal compared to any other development. We went from essentially an agrarian society to a high-tech industrial society by the late 1920s, all during a third wave. If we had an advanced decline line for that third wave, I think once again you would see that with virtually 100% of all capital being plowed back into business and zero going to taxes, that the number of businesses that were started and flourished relative to those that failed was probably much larger than what we've seen from 1932 to the present. Again, we have to stress that we're not talking only about conditions, we're talking about the rate of change of conditions. How fast did things improve? Well, can we describe wave 4 as a surprising disappointment? I think so. If you did a poll of people in 1928 and 29 saying, how's the future look? You would have gotten a vast majority saying, are you kidding? It looks great. But by 1932, just 3 years later, gloom was spread across the country, and people were saying, how could this possibly have happened? It was a complete shock to the financial world. Well, from there, wave 5 developed. Now, this is the chart we've been looking at all morning, from 1932 to the 1980s. And if you look closely, you'll see the 5-wave subdivision we've been talking about. Again, wave 5 should be discernible from wave 3 as weaker, both technically and fundamentally. We've already discussed the advanced decline situation that we probably would see if we had a chart of the 19th century. I think fundamentally we have the same situation. Certainly conditions are better than they were in the 1920s today. We've had a few new developments. We've got better cars, better houses, and we've come on stream with computers. But was the rate of change of the quality of living faster from 1932 to 1987 than it was in the 19th century? I think the answer is no, and therefore I still think that this 20th century advance is a 5th wave in a much longer sequence. Now, Frost and I only had data back to the late 1700s. We had to assume that a bear market preceded that point in prices in order to therefore come to the conclusion that 5 waves up had occurred. And in fact, a man named Charles Kirkpatrick got a very interesting idea. He said, you know, the colony's experience was essentially the same, or tied very closely to that of England back in the 1700s. Let's take a look at what their stock market was doing, and therefore roughly what the colonies were experiencing in terms of a market prior to the formation of the United States. And that is what he spliced onto the long-term chart of U.S. stock prices. We find that there was a major high in 1720. That, of course, culminated the speculation called the South Sea Bubble. There was a concurrent one in France. The crash that followed was horrendous. It wiped out close to 99% of the values that existed at the top. And yet the bear market wasn't over. There was an intervening rally phase that lasted quite a long time, and then a final wave C that, of course, brought us into very bad news, bad fundamental situation, a major war between England and the colonies. So the answer is that this 5-wave structure that we decided had followed Elliott's rules and guidelines so well indeed was born from the ashes of the bear market, a major bear market.